Some investors in Tesla view the company as a once-in-a-generation type of investment that they believe will deliver outsized returns, and they're expecting the stock not only to double or triple, but maybe even 10x or 20x. They see Tesla as a diversified investment with leadership in electric vehicles, energy storage, autonomous driving, and now also humanoid bots. All massive markets, all businesses that Tesla might dominate. With that, there are some investors that are now going all in on Tesla stock. One such ultra Tesla bull went beyond just going all in, but has now launched the very first Tesla-focused exchange-traded fund. The ticker symbol TESL is now trading on the New York Stock Exchange. Tad Park is CEO of Volt Equity and is the portfolio manager for TESL, a fund that concentrates on Tesla-related instruments. Joining us also is Alexandra Mertz, an ex-fund manager and is known in the Tesla retail community as Tesla Boomer Mama. Welcome both. Thank you very much.
Thank you, Herbert.
Thank you.
So, Tad, I'm very excited about this one. When I heard about you, and this is something that I couldn't believe even exists, right? So, tell us what this ETF fund is. You are on the New York Stock Exchange as TESL. Great name, by the way, TESL. And the way you describe it on your website is a fund that concentrates on Tesla-related instruments, right? Includes common stock, ETFs, swaps, options. Tell us, describe a bit of what this is.
Yeah. So this, the TSL strategy basically rotates between different levels of Tesla exposure, either 80%, 100%, or 150%. And the reasoning behind that is usually Tesla is a contentious stock. So it goes up and it goes down. And there is a bit of a wave to it, like momentum, because some people like it, and then there's a push and pull, and some people don't like it. And it is my belief that for momentum disruptive stocks, the best way is to slightly adjust the portfolio as it's going up or as it's going down. And that's all wrapped up into an ETF vehicle. So it's not for every single name. Like I wouldn't put Coke or Costco or something in a momentum vehicle, but for a really, really disruptive stock, the idea is how can we get as much exposure while mitigating risk a little bit, as much exposure as possible in a very disruptive name. And this is basically what was born, trying to have a very, very bullish Tesla ETF.
Yeah, exactly. I'm going to dive a little bit deeper on whether or not this is how you are different than the buy and hold. People are just keep buying and holding. Alexandra, maybe you can explain, like you follow quite closely all the funds, all the ETFs that have some Tesla exposure. Tell us who they are and how does, Tad's TESL, how does that fit in?
Sure, with pleasure. I'm not doing my daily tables anymore. I did at one point really follow those that had above average exposure in Tesla. And so that were the ARK funds, the ARK ETFs. And I was only concentrating on ETFs because people then come and say, oh, yeah, but the Barron funds, yes, the Barron funds too, but they are mutual funds. So you only have once per quarter a portfolio, while the ETFs, the good thing is you can see every day what the portfolio manager is doing. So I was following the ARK funds, Gary's fund, Ross fund at one moment, and VCAR. VCAR was the fund that made me meet Tad Park, and it already had this distinction compared to the other funds that it had options sometimes in there, and their options could be either bullish or bearish. And so I was always on my toes trying to understand what Tad was cooking there, and it was very interesting for me to follow up. And he always had, or most of the times had, an overproportional Tesla investment. The other funds, as you know, the ARK funds, only 3 of their funds are actually, of the ETFs, actually investing in Tesla. And they have this, in my view, very stupid, but there we are, limit that they can purchase a stock up to 10%, but once it's at 10%, they can let it run. We've seen them lately let them run to 16, even 17%, and then they trim it again and bring it back to 12, 13, 14, 15%. And if the stock goes down, or if they trim it more, well, they can go below 10% again and repurchase. So it's a very limited active management of that single stock because they promise their investors a very diversified portfolio. And so you find many other stocks in there. Gary feels that with 4%, he's ultra bullish. So that let's just leave that there. Ross, I'm not following anymore, but at one point, I think he came down to less than 2%. I think he's slowly building it up again. But never mind, it was a very small group of people that had an above average exposure. And what do I mean with above average is, so you have some funds that track just the S&P 500, right? And I think in the S&P 500, correct me if I'm wrong, Ted, Tesla is around 1.7 or 2% or something like that. So if they had more than that number, they were above average, but obviously that's still a tiny little number. Then other funds track the consumer discretionary index, and in that way, they had more Tesla, but it was still less than what the index had. So there are actually very few funds out there that have an above average, meaning above their benchmark exposure to Tesla. Tesla has always been a very controversial stock for these people. They have no idea what's happening. They found it expensive. If you compare it to Toyota, it probably is, you'll never get to a good conclusion about it. And so it was a very complicated analysis for me as a Tesla bull, because I just felt like this whole industry doesn't get it. But then there was Ted, right? And Ted restored my faith in intelligent people. And maybe, Ted, you should also tell a little bit your story, because you were not born fund manager, right? You were not, you became a fund manager because of Tesla, right? And I think you should explain that a little bit.
Yeah, sure. I think I've always been in software. So in terms of my day job before I was a fund manager, I was a software engineer, and I'm in the Bay Area. So, Silicon Valley, I see all these different up and coming tech companies, and I'm in it, right? I'm talking to people and everything. And I think one realization that I had was everybody around me is taking a pay cut in order to for some like outsized return one day, right? And then because they believe in these startups. And over time, I realized, all these other leaders, even the place I was, no offense, so even the place I was working in, I was like, they're not as impressive as Elon. Like I think Elon is way, way more impressive. Like his ability to grow the companies are probably going to be way better. So then I was thinking, okay, then what do I do about the situation? I'm working here. I'm willing to risk, right? I don't want to just have the same job like forever and never get out of this. So I'm willing to risk by taking the quote unquote pay cut to invest into disruptive investing. So if I were to do that, then how do I do that, right? These other companies, I didn't really believe in them. But when I looked at Tesla, I was like, wait, Tesla is a publicly traded company. You can actually buy their stock. And at that time, everyone was thinking Tesla, because that was around like 2018 and everything. Everyone's like, oh, Tesla's going to go bankrupt, all these other problems, all this fake news. And basically at that time, I was like, this is an asymmetric opportunity. And I pulled a HELOC, like a loan on my house. Wow. I do not recommend this to anybody. But the only reason why I did it is because the way I viewed it is I'll always have the ability to create a stable income because I'm very good at tech and software and those kind of things, right? So then if I have the ability to basically pay the bills and that kind of thing, then would I take a pay cut, basically equity, in a disruptive name? And I said yes. I had a very, very long conversation. My wife is amazing. She somehow let me. I have no idea. I don't think a normal person would let that happen, because if I was wrong about Tesla, we basically take a permanent pay cut for over a decade. But I was like, hey, I'm willing to do that. That's what other people are willing to do. Like, that's how I viewed it. I didn't view it as like a huge thing. So then what happened was Tesla, 10x, all that stuff. People started to realize, hey, Elon is more disruptive than we think he is. And then my mindset shifted of like, okay, I see so many problems in the normal institutional space. Like no one gets it. No one gets like tech because they're only looking at the balance sheet and what the company did in the past. But that's not relevant to companies that are completely going to change the world. Like when full self-driving comes out, all these other things come out, they're not looking ahead. So I had this like really burning desire to go into the institutional space. So I was started as a retail investor. I invested, millions of my earnings from Tesla into starting this ETF. Then, because I was very, very passionate about allowing many people to partake in what I viewed as one of the biggest like wealth creation events for retail investors. So how can I make it as easy as possible? I could have, made a hedge fund and said, hey, only rich people come to me and I'll manage it and, put a lot of Tesla exposure so that it'll go big. It's way more expensive to run an ETF, but I was like, hey, I'm going to put my own money into this and make it easily accessible for everybody to partake in this. And then over time, as the ETF was run, there was like an itch of like, oh man, I can't actually do what I want to do, which is out of all these different companies, I still am the most bullish on Tesla. So why do I have to hold all these other companies? And that's when I really, really pushed for the existing ETF to convert into TESL so that we are allowed to just hold Tesla. And that's how, that was kind of like the journey from retail to now, and where I hope to be like a counter voice to the traditional money management industry where they're like, hey, this is too quote unquote risky, or oh yeah, you can't put a lot into Elon's companies because it's crazy or something, But I think I totally disagree with that, and I think it is great to have more exposure to Tesla.
I love that story. It is wonderful. If you think about it, it's ridiculous already that we have these fund managers, these portfolio managers, and they say, hey, I'm an auto industry executive. And so I follow the auto industry and I'm following Tesla. Obviously, Tesla's not a car company. And so they completely focus on the wrong things. Worse yet, there's these people who are not technology at all, have no idea. And now they're following Tesla and they're commenting as if they know what's going on. So having someone like you who's a tech, born in tech first, just like Elon and his companies, who then appreciate and understands Tesla so much. You study Tesla as much as we do, Alexandra and I. So that is good to know. But okay, so I'm a buy and hold investor. I'm, considered to be as close to all in as you can be. And so are many other people. Why should I put my money in your ETF versus
Before
just
we
holding
get
it
there,
on?
Herbert, may I please ask a question? Because I think afterwards we won't get back to this topic. So Ted, so you had VCAR and you transformed VCAR to TSL, right? That's how it worked?
Yes, that's correct.
So how difficult was that with the SEC? Because usually they want their diversification and all those things, right? So how difficult was that, and what was the roadblocks? And I think then we can get to what's the fund radio all about.
Yeah. I think that's a good question. I kind of learned the hard way because people can the SEC can fast track ETFs, and you can launch an ETF, and usually when you change a strategy, it's like not a big deal. But then the other extreme is they can just say, oh, you don't have this, you don't have that, and basically make your life really, really difficult. And this one was something that's very difficult to get through. And I think, I don't know how off the record this was or something, but when I was talking to the lawyers, like the ETF, the securities lawyers, they're like, hey, Elon is not necessarily the most popular right now, is what they mentioned. But because I was like, wait, how is this fair? It's like there's these other ETFs that are fine. They're basically passive, where they say, hey, we're going to be 2x Tesla or whatever. Like those are not actively managed. There's no opinion, right? They're like 1x negative Tesla, 2x negative Tesla, 2x Tesla, or whatever. There's no fund manager that actually thinks anything behind it. But then when you're trying to launch this, and I'm like, hey, we're within the rules of everything. We did all this risk management and everything. Then why are they allowed to launch and we're not allowed to launch? And it was interesting to like see firsthand. Oh, okay, maybe the administration is not exactly pro Elon, and trying to fight that, and out of that though, I'm glad that at the end of the day we were able to move the needle forward, right? Because we like have this gigantic exposure to Tesla. In the future, if a fund manager now knows, like, hey, if we want to hold more Tesla, it's like, it's okay. Like Volt trailblaze this, and it's a lot easier for them to prove like anything else that has a lot of exposure to Tesla. But yeah, it was an interesting journey. Don't get me wrong, I'm very thankful to SEC. I I don't want to get on their bad side, but basically it was a journey, and I'm so glad that we came out the other end. But one thing I knew is that we were like, one thing that was confirmed is that we were original. Like there is something different about this ETF, because if you had a traditional like thematic ETF, like I would say like the original VCAR wasn't as hard to launch, because it was just, you just hold like, different companies, different tech companies, and it's a mixed thematic ETF. But this kind of thing is like, it's like the structure is just fundamentally different. I don't know of any other ETFs where a manager is like actively managing leveraged ETFs, like going crazy to the wall with exposure. I don't know of any ETF that does that. So like, it's been a fun journey. It's been awesome. It's kind of cool to have a product that's different. Because when I was thinking about it, I was like, okay, we could either be VCAR, normal thematic. It didn't feel right, because it was like, why do I have to hold these companies that I think are going to fail? Like if you have to hold autonomous car companies, and I'm thinking like, I don't believe in Cruise. I don't think they're going to win. I don't think that Waymo is going to win. I don't think any of these other companies are going to win, but I have to have exposure to them because of rules. So that really like made me push, hey, SEC, like we really got to have like all in Tesla. Like this is the thing.
Did you have to inform the holders of VCAR? Did they have to exit and come back, or was this just a smooth transitions for the clients that were in the fund?
Yes. So I had to inform the holders of VCAR, and yeah, everyone knew and everything, and yeah, it was it's a little bit tough, right? Because whenever you take a risk, there's a risk. Like who knows? But what if the holders of VCAR were like institutional investors, and they were like, what the heck? And they would leave, right? If you're saying, hey, we're going to go really hard on this thesis, there was a risk of that. But thankfully that did not happen. And actually the opposite happened, because after the strategy change, a lot more people invested in TSL, because this was a better product market fit. So yeah.
Okay. Great story, great explanation. It was a lot of work, but I think there's an absolute role for a Tesla-focused ETF that helps try to, really have that same conviction, and then try to see if you can actually actively manage it. You can explain a little bit more closely how you do and what you're doing. And just to be clear to the audience here, this is not financial advice. I am sharing information about this particular fund, and Tad is not giving financial advice. You can have to do your own research, go into his website, check out what this is all about, and decide on your own. Everybody has their own different financial scenario. I don't know if this is right for you. You have to go and figure this out. But the goal is to understand what is the options available out there. So Tad, I took a look at your website from Yahoo Finance, right? This is the TES ticker symbol from New York Stock Exchange. Looks like that you closed at $24, $25, but you are the blue, and in red is the Tesla stock. We're comparing the two, and this is just the 1 year view. And what I think I can see here is that when Tesla fell, the red, quite a bit in the beginning of last year, this is 2024, I believe, you didn't fall as much, but as Tesla rose, you rose more than they did. Can you explain this a little bit, and also how did you do that?
Yeah, so this wasn't fully the new strategy for the entire year, but the idea is the same, which is we were always doing momentum adjustments. So when Tesla is going down, we were trying to reduce our exposure to the downward movement a little bit. And then when it was going up, we wanted a little bit more exposure on the upward movement. So there is a little bit of a momentum investing strategy. When we look back to some of the best strategies, going back 20 years, I thought it was very interesting that momentum investing has been a strong strategy for tech companies, especially disruptive tech companies. So if you just bought and held like the FANGs or Amazon, Facebook, Netflix, and whatever, then that's one type of return. But if you actually momentumed them, basically just leaned into it, which is very, very counterintuitive, right? If something goes up, why would you buy more when the whole point is to buy low, sell high, right? But actually, it's because sometimes the momentum keeps going up. The general financial markets do not fully understand, in my opinion, they do not fully understand disruption. So if you look at what happened with Netflix or even the iPhone, right? With Netflix, they were just like, oh, Netflix it's totally not going to work. Blockbuster, like they're going to come out with Blockbuster Online. How are you going to survive? Like everyone in the financial industry was shorting Netflix, right? But what they didn't understand was, Netflix had the disruptive team, like they had the right mindset, and then all of the entrenched bureaucracy of Blockbuster could never compete to transform into a tech company. So when you, in retrospect, like now it's very obvious, but what did that do to the stock price? Well, Netflix like had these periods where it just crashes down to zero, almost like extreme crashes, and then later on extreme like euphoria because people realize, oh man, like Netflix might actually survive, right? And that's why like a momentum strategy, this is my opinion on why momentum strategy was actually successful for some of these, is because the public markets and especially money managers do not fully understand disruption, because it doesn't quack like a duck and like bark like a dog like they were taught in school, because it's forward facing. You can't look backwards and understand Netflix at that time. You have to look at the tech and say, okay, what will, from first principles, internet speed is doubling like every so many years. Right now, everyone's criticizing where it is right now of like, oh, it's still better to get the video cassette. It's still better. It's never going to work. But if you're looking forward and it's doubling, that means in 5 years, like, is everyone still going to say you have to get a cassette, or is Netflix going to suddenly go exponential? And if you looked forward with the, first principles, you would see like, oh, that's what's going to happen. And then you invest in it, right? But there's a market inefficiency there for disruptive investments. And then the best way to take advantage of that without getting like rocks is, in my opinion, momentum investing. So my end goal is the same, which is like, how the heck can I get as much Tesla as possible? Well, I'm going to take advantage of market inefficiencies when the mainstream media is like saying all these lies about Tesla or whatever, and everyone's like ditching the stock, like, oh, full self-driving is never going to work. Well, then I might reduce the exposure for my investors and for the strategy. But then when everyone is like kind of starting to realize, then I increase the exposure, because my conviction is that momentum might be a better way to, in the end, hold more of the disruptive name, at the end of the day, like when you look out, years into the future. So I'm applying the same mindset to Tesla.
Mhm.
Do you feel that Tesla is a stock that is in itself diversified?
Yeah, it's a good question. So there's a lot of traditional ways of thinking that have to be broken when understanding a company like Tesla. So I think, especially when you see the ETF creation process, it was funny. Even with like VCAR, they wanted they wanted you to hold like many different names, right? But if you think about it, if you took like all of the U.S. Solar companies combined or whatever, they would not even be like, the entire index is not as big as Tesla, or even a fraction of Tesla. So there are full ETFs that, in my mind, are like the entire grouping of securities is just, in my opinion, like losers. like no offense, not disruptive, just run of the mill. And they say, oh, this is diversified, but it's not, because any one tectonic change that can happen, and that entire quote unquote industry will be wiped out, right? If the whole point of disruption is to like, resilience of your investment portfolio, that's not actually disruption, diversification, right? Then I look at Tesla, and they are across all the verticals, right? Energy, AI, cars, all these other things, robotics. Like, this is a truly like green energy, disruptive and resilient portfolio, because it is like many, many companies rolled up into one. And in my opinion, it's actually stronger and more resilient in the long run than a whole grouping of losers. So that's why like it's kind of flipped on the head, right? So one famous investor was like, yeah, you just, people say don't put all your eggs in one basket, or you can put them in one basket and just watch it really carefully, right? So it's like, in a way, like, why wouldn't you have Tesla? Like, look at how resilient it was to a tectonic shift, right? Like, that actually killed entire industries, right? With COVID. If you have a genius at the helm, where somehow, when everybody says you can't make cars, Elon somehow made it work and survived at the other end stronger, then in a way, it's like, would you rather have that, him be the captain of the ship, of like, yes, a few eggs, but they're extremely resilient and strong eggs for a very well diversified, internally diversified company? Or would you have a whole bunch of losers all together, right? So in my mind, yes, Tesla is diversified in the sense of, on paper, it doesn't look diversified, but in substance, it is. Because when people diversify, it's for protection against weird market events and those kind of things. But Tesla is so strong that they are actually like stronger than an entire industry combined. So would you rather have like Captain America on your team, or would you rather have like a whole bunch of low-level soldiers that don't know what's going on, and like 100 of them, right? And I would much rather just like double down on Captain America, right? So that was some of my thinking of like, okay, I know everyone's saying, hey, for your investors, you have to quote unquote diversify. But I was like, okay, I didn't go into money management to do exactly the same as everyone else. And in my mind, this is my justification that it actually is diversified. And this actually is not as wild as it seems from the surface to be all in on Tesla.
Yeah, there's many of us that feel the same way. You articulated that really, really well. Just to be clear, though, maybe you can explain, because I think right now the audience might be thinking that this is 100% just Tesla, and that's not exactly correct. You have a partnership with Simplify. Can you explain a little bit of, like, when you say you pare down a bit, you just reduce your exposure? Well, you're buying a mutual fund, right? Can you explain a little bit of what you're doing there?
Yeah. So in terms of the the exact details of the ETF, please look at the prospectus. Go to boltfunds.com. Look at the actual fine print and stuff. That is what we're actually bound by, is the prospectus. And do your own research and everything. But basically, we are partnered with Simplify Asset Management. I think it was a very, very great fit, because if I tried to partner with someone else, well, first of all, they would think that you're crazy. That they're just like, hey, you're not a traditional money manager. You don't look like a traditional money manager. Like, we don't want to launch any of these crazy ideas, But luckily, Simplify took a bet on me, and they were on the cutting edge of alternative investments. So they bet back in 2020, and they're a startup themselves. Even though they have decades in the industry, very, very smart guys. Like the CEO, went to Wharton, and a co-founder was like a MIT PhD in like quantum computing, like very crazy, A-team finance powerhouse. But yet they took a bet on like the guy who did not have a traditional finance background. So still to this day, I'm like, yeah. Like that's kind of interesting. Like how, like they somehow took a bet on me, that I did not have the traditional finance person's background. And they thought, hey, we're trying to come up with innovative ETFs and innovative investment vehicles. And they're like, hey, I think Tad can help us get there. And that's how the partnership happened. Then what that means, though, is they also have a certain portion where they have their own algorithms, and they have their own like goal for managing certain types of market risk. So a portion of the ETF you'll notice has like these interesting holdings, a whole bunch of different names, and sometimes they're buying options, selling options, and whatever. But essentially, it's like a self-funded options portion of the portfolio. I mean, to be honest, I don't exactly understand what they're doing there. They are risk managing that portion. But that's why they have, David Burns, the MIT PhD, on their team, because they have all these very sophisticated investments. And the main thing that they're trying to do there is, if there was a tectonic event like Great Depression or COVID or like something like that, hopefully their risk management, all of the crazy things that they're doing, hopefully that can be enough insurance that they can mitigate like a crazy drop. Like I think that's basically what they're trying to mitigate, is like tail risk events, like something weird happening that no one expected. And they're like kind of in that space. But in my space, I'm the portfolio manager for the Tesla side of the prospectus, where I'm just like, hey, anything to do with Tesla, I'm watching it, and I'm the expert on Tesla and Tesla, everything, including momentum. We have our own algorithms and our own software for the momentum side of Tesla and everything. But basically, yeah, we manage all that stuff. We use software that we developed called Eagle Trend and Ambly for the option, Ambly.io for the option stuff. But basically, we do all that stuff on the Tesla side. But basically, I let them do their thing, and in general, they let me do my thing, and that's how we manage the ETF. But
Mhm.
I
technically,
think this is
we
a great
are
partnership.
together.
Yeah, I think this is a great partnership. When people watch your daily publication, right, in the evening when you publish, or the next morning when you publish the funds portfolio, can they see your current exposure, or did you do that secondary website like you did for Vika in the time to give more information than just a portfolio look?
Yeah, yeah. So we updated Volt Funds to handle that, and there is a breakdown where you can actually see like a pie chart of the exposure, and you can see the breakdown, and it's an ETF.
I think I'm going to publish this for a couple of days. I think it's going to be very interesting once you've published the video, Herbert, for people to follow, you know, how the exposure varies, right? Because your goal is between 80% Tesla and 150, right? That's the range you're targeting. Okay.
Yeah, yeah. It may not change that often. So just I mean, just to clarify, like every investor has like a timeline, right? So personally, I don't think it fits in the thesis for like day trading and stuff, because day trading is as a Tesla investor, I don't believe in that. You know, it's like basically you're for the people who can do it, that's great. You put the finger in the air and then you can quote unquote day trade, but it's based on chance and it's not based on conviction, right? But and then you can have like buy and do nothing, or it's like a middle ground. It's like, okay, you think something, like, on the timeline of weeks or months, like you think that, oh, okay, the market is not quite pricing this in, or there's some inefficiencies here, and there might be like certain options that I purchase in a strategy like this, right? Like, for example, even though it goes from 80%, 100%, 150%, sometimes, like, in my opinion, it's not fully captured in a momentum strategy, where what if, like, suddenly Tesla achieves full self-driving and the whole market goes crazy, right? Then as the price is going up, you can't actually capture that move very well, even with like momentum. So we might purchase some call options just for the insurance against that kind of event from happening. So we are like, we know that it hurts performance. Like, if you're consistently buying call options, it will hurt the performance of the ETF, but I think it's the best for investors, because if an event like that happened, I want my investors to participate in the upside if Tesla achieves like a really momentous, disruptive event like that, right? So
Yeah.
yeah, but in general, the timeline of the switches is not that often.
It's
It's
weeks or
just
months.
yeah,
Mhm.
yeah.
What I love is that you are a software guy. You're a tech first person. You've created this financial analysis software that is got algorithms, and then you calculate. I think you told me, right? Calculates your probabilities, even with the call options, with any of these kind of instruments that you're using, the probabilities of what will happen, and you're basing it on that. It's almost like playing poker, blackjack, or something, but having software with you that's got this probabilities, and then there's of course you, the portfolio manager, just overlooking all that. But you know what I mean? Like, you have a Tesla bull who's following every single bit of news, like every single bit of news every single day, and then you're backed with some probabilistic software that helps guide your decisions. Is this correct, the way I described that?
Yeah, that's correct. Yeah, so I'm definitely very influenced by I used to really like poker. I still do. I don't play, but really like the concept of expected value, right? And that's actually that's actually how I got into this type of investing in the first place. Is that a lot of VCs here, right, in Silicon Valley, they're like, oh, they'll invest in all these different names, 1% in 100 different companies. But if one of them goes like 200x, then that one investment paid for everything else, right? So here, that kind of investment thinking is common, right? Do you see that anywhere else in like the entire finance industry? You don't see it anywhere. It's only in private investing, right? But then I see this in tech all over the place. Like disruptive names can do outsized return on a portfolio, right? So when I thought of Tesla, I was like, hey, this is an expected value bet. It's like I think either the markets think that Tesla's going to hover around here, or the thesis is right and Tesla's going to 10x. So that's the way I thought of Tesla in 2018. And that's why I went all in, because I was like, okay, the downside is limited, because how can people think that Tesla's crappier than they think it is with the mainstream media? But if they make their goals, the upside is crazy. And I still think that Tesla's in that position right now. But the way that thinking goes is it's expected value investing. It's not, I guess, traditional finance investing. You're thinking more like a VC than you are like a other types of things. And I think the VC type thinking is more appropriate for disruptive investing. And that influence of like, okay, I see all these people, like in poker, why is it that these professionals always make it to the final table? And people can say, oh, it's just gambling. It's just gambling. No, it's not. If the same people are making it to the final table and beat out 10,000 people every single time, that's not gambling. So what they are actually doing is they're investors. They're expected value investors. So some fascinating things with like poker is like pocket aces or two aces is considered in Texas Hold'em as like one of your best hands, right? In the beginning of a tournament, if you have the best possible starting hand and everyone went all in, you have the highest chance. Then would you like also call? Like, would you want to be part of that pot? Probably, right? But for a professional, they will actually fold, because they will not play in that hand, because they know that they're going to have more expected value. Like it's like a marginally expected value, but what's the downside? The downside is they lose everything, right? So even though they have the best possible starting hand, they will just stop. But when they're in these other situations where the statistics are in their favor, they will take that bet all the time. And it's a small bet, a very small bet, and they just constantly have it in their favor, and then they make it to the final table. So I think about that in terms of investing too, is like, how can we find like asymmetric investing? How can we bring this new way of thinking, especially like it's like a paradigm shift of tech investing. I think the industry needs to think like this more. There are not enough tech people turned money managers in the securities, like in the investing space. Like most of them are MBA, like New York person, and that's it. Like they are all taught like stocks, bonds, whatever, and that's it. And that's the only way of thinking. So I think there needs to be more of this, where expected value is a factor of investing. Disruption is a factor of investing. Forward-looking tech is a factor. And because of all those different influences that I had, I also applied that to the software. If everybody else is doing like software a certain way, it heavily influenced the type of software that I make to help manage the fund, in that it has the same way of thinking, right? If other people are making mistakes when they buy options, because they might be right, like they think, oh, it's going to go up, and that's all they know. But if they don't allocate correctly, like they're not using like statistics or Kelly criterion or all that stuff, if they allocate wrong but they're right on the direction, they can still lose money, because that's a leak in their game, right? Or they're right about like certain things, like maybe they're right about this, but the direction, but not the timeline, and different things, right? So I'm going to use every edge that I can for my investors. So if there's all this like probabilistic data, then if I can take advantage of that, I'm basically being like the professional poker player where you're making the positive expected value bet every time. So how can you most efficiently get buy options and make more correct moves than not, versus someone who's just like wildly doesn't know anything about options, going all over the place. Yeah, they might make a couple good bets and stuff, but that's not efficient. Like I want a lot of at bats, right? Because I'm very efficient at it, I want a lot of at bats. So that's very similar to like a professional poker player where they will fold that best hand if they don't have any more at bats after that. Then no, that's not a good deal. But if you're very efficient, then you can like constantly like eke out that edge. So when I see that the tool says, like recently, for example, Tesla going up 10%, the tool said that it was 1% chance during Trump's win. But then the thinking was, I was thinking, you know what? If Trump wins, this was not implemented in the ETF, but I'm just showing you the power of the tool for like Ambly.io. Is that the thinking is, if the markets think it's like a 1% chance that Tesla goes up 10%, but my thinking is, I know the mainstream media is saying Kamala is going to win and she's like 60% chance of winning. And I might be like, okay, I'm going to adjust for that and different biases. I think it's 50-50 chance that Trump wins, right? Well, that is a huge opportunity because I think that if Trump wins, Tesla is going to go up 10%. So if I buy that option, there's I see the market differential where the market is pricing in 1% chance, but I think that the real chance is 50% that Trump wins. So then, what happened? Like, if you look at that actual option, it went up a crazy amount because Tesla did go up 10%, and you got a crazy asymmetric return. So imagine you purchase just a small portion, like a 1% exposure in options for that bet. And bear in mind, half of the time you will be wrong and everyone will think that you're a fool, right? But if you're thinking like a VC, will you put a 1% bet where half of the time you might even make 10% return on your portfolio? You would. So no one thinks this way, right? Or this is a very rare type of thinking. So that's the way that I think, where I'm like, okay, I'm going to use Ambly. It shows me this market opportunity, and then I'm like, wow, that's a huge opportunity. Then I place like a 1% bet, right? And then so that's how like the tool and options like kind of fit in with the strategy. But it also shows a little bit about like the way I'm thinking is like, it's definitely expected value is a portion of the decision making process.
Mm-hmm. Yeah, so you have a financial analysis software that you've created. The one you're referring to is called Ambly.io. And then there's also eagletrend.com that people can check out. And you actually use the software that you created to help you with your decisions. I love the way you describe that. Can you share with us a little bit of what you're thinking about the stock today and what it's gonna go? I know you're a big bull. You believe that robotaxi is solved. It's gonna be successful at some point in the future. And bots, of course. What's your expectation for the stock?
Yeah. So long term, I know that I may not know the exact path, but long term, I'm very, very bullish that I'm willing to bet that Elon is going to hit his goals. He's done like amazing, crazy things that no one thought was possible with Starship and like all this other stuff. Everyone's saying it was not possible, but it is possible, right? And I think that we're going to be on Mars one day. So that being said, in terms of the timeline for full self-driving, I actually see it happening before my eyes. So I wasn't like a perma, like full self-driving is here, So I mean I was seeing like FSD beta like from pretty early days. I'm very thankful to Omar from Omar's blog for like showing me in the early days of that and everything, and it was great. But then after I got accepted to the beta and then I was testing it out, I didn't really say like, okay, it's here, guys, it's here. I was like, I wasn't really tweeting that because it wasn't. I was intervening like all the time, like literally like all the time, and it was very difficult to use. But what was interesting is maybe there's like 10 interventions for the trip, but then an update happens and then it goes from 10 and it's still 10, right?
Mhm.
Another update happens 3 months later and it goes from 10 to like 9. And then it's like, it's still 9. It's still 9 for multiple updates. And then suddenly it's like, it goes from 9 to like 6. And then the next one happens and it goes from 6 to 3. Like basically what that tells me is that it's an exponential increase in improvement. So when people think of like exponential curves, they're just like, oh, it's never going to happen, right? Because it seems like there's no progress for the longest time. But the thing is, it takes a little bit longer than people initially think, but also the end part of that tail moves faster than people think as well. So when it starts going exponential, it's like crazy. So right now people are like, they're thinking linearly. They're like, hey, I still have to intervene in FSD. So therefore, it's going to take 5-10 years for FSD to be solved. And I totally do not believe that. I think that back then, it's like you couldn't tell because the improvements were so hard to see. But now, like I see it in my actual Tesla, I think we are approaching the exponential part of the curve. And what that means is, yes, people say there's a long trail of 9s before you get self-driving. But I think we're in the exponential part. What does that actually mean? That means it will happen way sooner than people think. And what does that mean in terms of opportunity? I think that Tesla will achieve self-driving earlier than traditional money managers are going to think it's going to achieve self-driving. So that is my conviction. People can take what they will out of that, make their own decisions on what that means for Tesla stock. But I actually think we're in that exponential part. It's super exciting. If we just look at what's happening with AI right now, it's crazy. Like Moore's law is like, in computing, it's like the processing power doubles every couple of years, right? It's way faster than Moore's law. Like the pace in which AI is getting better is way faster. Like when NVIDIA revealed their new hardware, it was like a 20x improvement.
Yeah.
So we are going to rapidly improve, like way faster than people think. It's a super exciting time. I think that Elon's presentation with like a self-driving robotaxi, it's the appropriate time because I think it will happen less than 5 years from now. So I think it's well on its way that it will happen. Yeah. What about you guys? What do you think about that? Like self-driving.
I'm much more optimistic in 5 years, Ted.
Yeah. Yeah. I think that even if you double Elon's estimate of this year, right? Like mid this year, even if you double it, that's still this year. It's super exciting. Yeah.
It's one thing when Elon says it's going to be done by the end of the year, or it's going to be done, and he kept saying that every year, to it's going to be done in 3 months because they're already using that software. They already know the data, and Ashok himself said it too. I'm not saying that it's what does that mean, because you can fudge around with what do you mean by that, safer than a human. They haven't yet published the actual intervention rate, so we don't know. But, could just be a marketing term versus actually reality. But I think what we're all watching for is signs of whether or not these milestones that they've laid down is anyway being delayed or not being delayed. are we still on track for commercialized robotaxi sometime in the second half of this year? And so far today, it seems to be still on track. So you're just always got to keep watching for any sign at all to show you that that's been delayed or not. And right now, we're not hearing that yet. We'll keep a closer eye.
Yeah. One thing on that, it's like I saw such a like exciting thing where there was a chart about the improvement of AI, and what was super exciting about it, like is when there was more data, it improved. Like it did not approach the asymptote, right? So all you needed was hardware, all you needed was data. Like, and
that's what they know.
That's so encouraging, because it's like we have more miles. And if that's the only thing, that's like an easy thing to solve, you know?
Yeah. So as of today, Tesla has 7 million cars. Even if they have FSD or not, those are all have tracking information, tracking data. They've been tracking it. Now that they've increased their compute, they could take more of those video and put it in. They actually know all of the different kinds of interventions that are happening. They know all of them. They've got a whole list, and they could tell you which interventions are critical, which ones aren't. And now I've solved a few by throwing in more data. So now they go, okay, well, if I throw in more data, this will be solved, this will be solved, this will be solved. They can already map this out. And that's what you're betting, is because they already have the data. They had way too much data that they did not upload all that data because they didn't have data centers to host it. But now that they do, the more that they increase that, the more that they can put in that data. So
yeah. And that's actually a huge mismatch between traditional investing world and people like, us, right? In that most people do not understand that, where I think it's absolutely ridiculous that they think Waymo is on the same level as Tesla. They're like, what the heck are you doing? It's like a Waymo is like, they're like, oh, but the Waymo ride was smoother. It's like, you don't understand. They don't understand the tech, because yes, that was a Disneyland ride where you have to like sit in there, and it was pre-mapped, and it was it's a small world with the little teacup moving around. But then this is an actual brain. This is like real AI. Tesla's real AI. But the reason why Google is not going to say that, and everyone's like, oh, who's better at AI than Google? Well, you have to understand how AI works. Like, will 5,000 cars have the data required to make the brain work? They do not. Only Tesla's millions of cars will actually solve it at that level, where it's not a show. It's not like a choreographed show. It's a real thinking robotaxi, and only Tesla is doing that. So when you view that as an investor, right, a first principles investor, it's so different that I'm like still mind boggled that the investing world does not realize, and they even bring Waymo into the same conversation. It's like, it's kind of offensive to me. It just fires me up into like launching the CTF because it's like, this type of thinking is not quite there.
I made the exact same joke, by the way. I did a post about a month ago, and I said that people who think that Waymo is successful, there's actually another company that is the leader in robotaxi rides, paid robotaxi rides, that has millions more rides than even Waymo has, and it's Disneyland. And Disneyland it's geofenced, but who cares if it's geofenced? If you're counting commercialized paid robotaxi rides, they have the most. Am I right or wrong? It's correct, right? So it's obviously like, if that's what you think Waymo is a leader, think about that. Okay. Well, Tad, this is great. So this is unique. You've created the first ETF that is focused on Tesla. You are using financial analysis software because you're tech first, you're a software guy. You're using that to help guide your decisions. You went against all odds to actually work years to create this, because it's not normal for you to have an ETF that is focused on one company. But you've got the partnership with Simplify. You're listed on the stock exchange, New York Stock Exchange. I love TESL. That is like, you can't get a better ticker symbol than TESL. That is so good. Yeah. Alexandra, thank you for joining us. Any other last questions there, Alexandra?
No, I'm happy. I've been watching Tad now for 4 years. I love what he's doing. I trust the man. I think they have put something very special in place, and it's great. It's great to have you here today, Ted, and it's great to watch you in the coming weeks and months.
And likewise, I'm just so thankful for the Tesla community in general. I'm
Right?
thankful
Isn't it great?
Herbert and Alexandra. Yeah, it's like the best community out there, you know, and so supportive and everything. Like if you just look at it, right? Would you be part of Tesla Q? Like a completely negative and like the world is, I don't know, there's negative view of everything, or would you be part of the Tesla community?
Sure.
You have an optimistic view of the future. It's just so much more refreshing. I feel like the people are just nicer too.
And you'll make more
That's
money.
true. And brighter, right, Herbert?
Brighter.
Yeah.
But of course, again, just to wrap this up, was not financial advice. Being very, very careful here because we are talking to somebody who's a portfolio manager, and you have to be careful the words you say typically. But we have that disclaimer everywhere. Everybody knows that I'm a Tesla investor. Alexandra's a Tesla investor. Tad is a Tesla investor. We are bulls, but you can decide on your own what is right for you. So decide that. Thank you so much, Tad. I will put your descriptors in there. I think you are your X account is Tad Park 0. You are the CEO of Volt Equity at Volt Equity. And sorry, what is your website? I had it.
Voltequity.com.
Voltequity.com. And then you can look up the New York Stock Exchange at TESL. Thank you. Thanks, everybody. Bye-bye.
Thank you.
Thank you.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.